I'm Jeremy,
I'm Joel.
and for our stock pitch, we are pitching DTE Energy, which stands for Detroit Edison Energy. And this company, it's a electric utility company based out of Detroit. And I guess we can just flip to the second page just initially to get a company description. They're a Detroit-based diversified energy company involved in development and management of energy-related businesses and services nationwide. With their electric utility, they service 2.2 million customers in the Detroit area and in southeastern Michigan. And then they also have a natural gas utility that services 1.3 million customers in Michigan. And then they also have a non-utility segment of their company that provides power and industrial products, natural gas pipelines, gathering and storage, and energy marketing and trading. And so these segments, they're about split 50-50 as far as revenue goes. But we can swap back to the first page now. And so our thesis is that diversification protects and provides opportunities for DTE Energy. Their current price is $111.24, and the target price that we came up with was $114.47. So not a huge upside, but about 3%. And currently they're about at their 52-week high, but yeah, they're well above their 52-week low. They don't sell a large volume every day, but it's not a small volume at all. And they have a relatively low beta with 0.43, so they're a pretty defensive stock with a $20 billion market cap and 3.9 billion shares outstanding.
Yeah, so what's so interesting about this company is that they're a utilities company, but they invest in a non-utilities sector. So they provide energy, and the biggest threat to the energy producers and suppliers is regulations, and they found a way to profit off of regulations. So they buy landfills, and they have facilities that allow them to take the greenhouse gases that are produced in landfills and turn it into energy and then sell the energy. So basically, people sell them their trash, and then they sell them the energy that they produce from the trash, which is very profitable. And then they also go to industrial facilities, refineries, steel mills, places like that. And while they're producing emissions and regulations come in, those facilities, they need ways to cope with the regulations to bring down their emissions. So they hire DTE Energy, and they come in and give them the equipment that they need to deal with those regulations to bring down their emissions. And a lot of the times they manage to take the emissions, it depends on what it is, and then they can sell it to other companies as well. And it sort of makes a circle of what happens to the waste in those companies. But basically they can keep reselling it and turning a profit. And then they also are invested in coal right now. And what they started doing about 10 years ago is they started selling off almost all of their coal facilities. And the ones that they are keeping, they're creating additives that they can put into the coal to reduce the emissions when it's burnt so that they can stay within the legal limits. And then another thing that they're invested in is coke. So coke is something that you can get from petroleum products when you refine it. It's a lot of the times it's found in dirt, sand, in Alberta, Canada, for the most part. And 80% of it is used to burn, just like coal, for the exact same purpose, but it's 10% more damaging to the environment, which sounds like a bad thing, right? And the biggest consumer of it is China, so they ship it over to China, and it's terrible. So they're putting all these regulations about it, and it's going away. But what we found out is that they produce the top 20% quality of it, which is used in the production of steel and aluminum, and it's not burnt, and the demand for it has not decreased since all these regulations came in. So they've also shut down their old coke producing facility and bought a new one so that no matter what, when the regulations come in even heavier, they will not be affected by them, which is really interesting. So one of the biggest threats to them are those regulations, and they've also expanded quite a lot. So they were all downstream, so they took the energy and they sold it to the consumer. But now they're expanding into the midstream, they're buying pipelines and facilities to transport natural gas, mostly, across the eastern coast. So they bought hundreds and hundreds of miles of pipelines that allow them to sell their products to many more consumers than before. So now they're doing business-to-business transactions and not just business-to-consumer transactions.
And then if you look at their stock performance on the left side, can't really tell which line is which, but DTE is the top line, so they move pretty lockstep with the utilities sector. However, they are starting to increase their margin between them and the utilities sector. So they're starting to perform better than that on an annual basis. And this is a 2-year chart, so you can kind of see a full year cycle in there also. And if you look down at their financial and valuation metrics, their revenue has been increasing year after year. Their operating margin is mainly fueled by their utility segment. Their utility segment, they make about $6 billion in revenues and only have roughly $1.5 billion in expenses, while their non-utility segment has the same $6 billion in revenues but has about $5 billion in expenses. So it's not as profitable of a business, but they're still able to make money from it, and it still helps them be able to grow. And then their EPS has also been growing fairly well in a consistent manner. Their PE has been decreasing also, which is a good thing as their earnings are increasing. And then if you flip over, you can see our target price valuation. We did a DDM model, and their dividends per share this last year were $3.36, split up over 4 quarters. It was about 88 cents a quarter. And then we used a discount rate of 5.4, which we got from the valuation template. We plugged in their balance sheet and income statement, and that's what it came up with for their discount rate. And then for the dividend growth rate, they were fairly inconsistent. They have been increasing their dividends, but not by a consistent percentage, and so we decided to just use the GDP growth rate, which was 2.39. And so that gave us a share price of $112.26. And then for our relative valuation, we took the average PE for the comparable companies that we found for them, which was 21.06, and compared it to their PE of 20.08, which gave us a target price of $116.67. And we just averaged those two to come up with the target price of $114.47. And we already talked about the company description. Their management has been doing very well. They have fairly long tenures for all of their executive positions. I think the most recent executive was hired in 2013, and so they've been in the company for a while, and it's continued to do well under their management. And they their change in insider position was a little down, but it wasn't down by a ton. They aren't trying to sell off their stock thinking it's going down a lot. It was just mainly they've been exercising options that they've been given as payment, and so they're able to buy 100,000 shares, and then they at a discounted rate, and then they go back and sell it at the normal stock price. So there's not too much change in insider positions, and then their pay has also been fairly average for the industry, so they're not being overpaid for doing poor work or anything like that. Talk about their operations.
Yeah, so we pretty much already went over this, but as for their competitors and for threats to them right now, in Michigan, where half of their revenue comes from supplying electricity to Detroit, it doesn't look like there's going to be any heavy regulations put on them to cut their revenues back. Detroit actually just approved them to charge higher rates to their customers.
Mm-hmm.
So that was one thing that we saw, and
so they're able to get a 10% ROE now, which was approved, and so they're able to charge higher prices without incurring additional costs or expenses towards their company. which is good news for them.
And there's not a lot of direct competition with them when they're going out and buying dumps and landfills. Nobody's really competing to buy the same thing that they are. The biggest competition for them would be the pipelines that they're trying to purchase and the facilities that they need to store and transport the natural gas that they're selling. But they've been doing a pretty good job of acquiring those assets. They purchased 2 new pipelines that were about 500 miles long, running east to west in the past year and a half. So they've been doing a fairly good job with that.
Tell me about these comps that you have listed here. So you have 3 comps. How did you pick those comps?
We picked them based off relative market cap. They're all larger utilities companies, and they all supply electric utilities and renewable gas utilities for cities. I don't remember which ones exactly right now, but they all had similar business models. They don't necessarily specialize in the same non-utility segments that DTE Energy does, so that may throw off some of the numbers a little, but they all had the same primary business model as a utility company.
So how much of DTE's revenue comes from these alternate lines of business versus its electric utility?
It's about 50%, it's a little under 50%,
Okay.
but for each of them, each of the utility and non-utility segments are between 6 to 7 billion in revenue. It's just mainly the expenses that are different, but yeah, the utility brings in more, but not by too much.
One thing I might want to see for a utility like this is just looking at their capital expenditures over time. Just because if you think about the drivers of growth for a utility, it's the demographics in the area they serve, the rates they're allowed to charge, which are usually set by regulators, and then just how much they're spending to kind of broaden their infrastructure, right?
Yeah, and I had that in the valuation spreadsheet, so I can send those numbers to you. But if I remember correctly, I think they didn't expect to have any capital expenditures in the near future. They weren't planning on expanding too much more recent in the near future, but I can look that up and see. Because I thought it was strange too that because it said in the 10K that they didn't expect to have large capital expenditures in the future. They'd already kind of set up what they were going to do business in, but.
Sure, I mean, if they're expanding to a new area, you'd expect to see significantly higher CapEx, but they should be having some maintenance and regular kind of routine CapEx as well to maintain their infrastructure.
Yeah.
So I'd like a sense of just what their kind of routine maintenance costs are. When you see companies delaying a lot of maintenance, because sometimes they do that, they kind of, to improve their earnings, they might put off kind of necessary maintenance for a year or two or to push it into a different reporting period. But that would be paying down the road instead of paying now. So we just kind of want to see that they're kind of have a steady rate of CapEx that kind of makes sense for the business.
Okay.
Do you want to talk about how they meet their earnings forecast?
Oh yeah, they have consistently beaten analyst estimates for their earnings.
It's on the last page.
Yeah, if you go to the news and catalyst section. So they increased their earnings from $5.94 to $6.32 a share, when they were only estimated $5.79, and consistently for the past year, since I think the third quarter in 2017 they missed it by a few cents, but since then they've consistently beat earnings and been doing really well since then.
For the dividend growth rate, you might consider using their payout ratio, see if that's been fairly consistent, so
Yeah,
the dividends
I
they
think-
pay relative to the net income,
I think it was about 3% around there.
and that's been fairly consistent.
For the most part, yeah, it's been fairly consistent with their stock price. It's last year they were paying out about $2.87 in dividends, and so it rose about 50 cents this year. but for the past couple of years, it was rising by about 1.9%, and then in the recent years, it started rising by like 4%. Just
Their actual
between
dividend or their
dividends.
payout ratio?
Dividends themselves.
Okay, so you might look at the payout ratio and see if that's fairly consistent, because if you see like if their dividend payouts kind of was in lockstep with income, that's pretty typical, as a lot of companies will target maybe a specific payout ratio or an approximate payout ratio instead of a specific dividend growth rate.
Okay.
Makes sense, okay? Because I think if you're saying their dividend growth rate, well, it would give us maybe a better estimate on that DDN model. Although your assumptions look pretty safe here, it might be good to just double check out.
Okay.
Peter.
So in the front page, you can see clearly revenue growth. I mean, especially for a utility company, I'd say that's good. However, the operating margin has decreased by 4% and has been doing that, which would, at first glance, kind of looks like while they're making more money, they're actually becoming less efficient with their costs.
That is due to the acquisitions they've been making. So non-utility sector, it heavily is affecting that margin. So what was
Because they're making like 6 billion, 6.3 billion in revenue from their non-utilities, but they have about 5.5 billion in expenses for that, which is about 3 or 4 times as much as their utility expenses.
and when you go through their 10K, they separate all of it for you so that you can see the extreme difference between the two.
So it might be helpful for you to present that information to us also, just a breakout by segment. Like when did they start moving into these other lines of business? It sounds like it's fairly recent.
Past 10 years.
Yeah, within like 2008 to 2010
So
was when they really started.
So you have 2 separate lines of business that behave somewhat dissimilarly. They have different kind of operating margins, et cetera. But then the justification for moving into the separate line of business is kind of to limit risk, right?
Yeah.
Utilities are usually a sector that you're investing in kind of for safety,
Yeah.
not because you're expecting a huge amount of capital appreciation. So the question I pose to you is, do we want a pure play utility, and then do we want to maybe invest in some other company that does something similar to this with like the recycling and coke operations? Or do we think this company does a good job of managing both, and we want the diversification that this management has decided to opt for?
We decided that the diversification made this an even more stable stock and a safer bet.
I guess when we look at it from a portfolio management level, like we could go find one pure play utility and one company that just does coke and whatever. Sorry, that just sounds funny saying. So it may make this stock safer, but would we be better off if we found, because we'd get the same kind of level of safety and kind of balance of risk if we had a pure play utility and basically 2 companies that kind of reflected the 2 different types of operations of this company in our portfolio. Does that make sense?
Yeah.
So why is it more attractive to have them all under one kind of management team? Do we like the management team? Do we think they're doing a good job?
So as the atmosphere in the energy sector has been changing and the regulations increase more and more, the other utilities that aren't renewable energy are under a lot of strain right now, and they're all being replaced by the renewable energy utilities, which are these guys. There's not a lot of renewable energy utilities companies that are doing very well, and this is one of the few.
Okay.
So that's why we ended up with this company compared to other utility companies.
Other questions from the class? Peter?
So if you look at their 10K, roughly 50% of their employees are union, those people. I don't know what to call them. So
Unionized.
unionized workers. Yeah. So one thing I would like to see is, it probably isn't a big deal if it's a good company, but how many strikes there have been in the past, or just kind of things like revolving the union and this company. does union like secretly hate this company for, because they've been treating, you know, with
Yeah,
collective bargaining
I
and
haven't
everything?
seen anything about that in all
Okay.
the research we've done, and on every single one of their websites for all of their different little segments, there was a lot of stuff about their employees, and their
Mhm.
employee safety, and how that's the most important thing to our company. So it seemed like it was pretty important to the company to keep their
So
employees
that's
happy.
good PR, and most companies will say something
Yeah.
along those lines, but it's a valid point to maybe look at, like, the next time they have to sit down at the table for collective bargaining, and just see if there's any contentious, like, you can usually find the last time they had to sit down, because that's usually at regular intervals.
Where would we find that?
They probably have to disclose in their 10K the next time they have collective bargaining arrangements.
Okay.
And most companies like have regular intervals. It's usually set. It's not. I mean, like for
Mhm.
example, at the university here, the unions negotiate every 3 years, and so then you could look back if it's a 3-year period or a 5-year period or whenever their last negotiation was, and just see kind of what the outcome was and if it was contentious. That might be a way to kind of gauge their labor
Yeah.
management relations.
Now, a question on that, when you guys are looking at that, something to look for is what type of union it is, and when they made their
Yeah.
last acquisitions, and see if it is maybe a pipe fitters union, or are they gonna try and unionize? As part of it, are they gonna have to bring in those new pipelines that they just acquired? That might change the cost, because now they might have to pay all those new pipe workers that they have more. So
Yeah.
that would change things.
Yeah, okay.
So especially if it's coming up in the next year or so, and that might affect if they're looking at buying a new pipeline, that might be something that they would then delay.
Mhm.
So, yeah, unions are, especially in certain sectors, you will find labor is unionized, and it's usually fairly standard, like it's not like one utility has
Yeah, I've
unions.
had some experience with that.
Although, like, you will find, because utilities are fairly localized, you will find some differences, just because there's some like states that are like right to work states, and so you have different like labor regulations. So some states are more union friendly than others. I imagine Michigan is probably pretty union friendly. It's kind of like one of the birthplaces of unions in the US.
Yeah.
Although I don't know a ton about their union regulations, but I probably would say it's good to check on. I'm not thinking that's gonna be a huge driver of risk in the stock. I'd probably do a quick check on like the demographics in the area that they serve, and just see.
And the non-utilities or utilities?
For utilities, because think about the drivers for utilities, it's literally like how many households are you serving, and
I
what
think
rate
it's
can you
about
set?
900,000, just in the Detroit area itself.
But I'd look and see, like, is the metropolitan area growing or not, because for a long time, obviously, Detroit was shrinking. Now, I think it's leveled off in terms of shrinking. I'm not sure if it's growing, but we'd want to know that to think about the prospects for the utilities business, okay?